This is an overview of basis rules, depreciation, and asset categorization. So we're going to talk about the difference between income versus capital. So tax is levied on income, not capital. Capital is what we're investing. Capital is income that has already been taxed. And we're going to talk about the tax toll booth. So there's different types of gains and recognized income and realized. So you must make sure you understand the definition of these. Gains must be realized before they can be taxed. A gain is not usually realized unless there's a property disposition or a segregation of the gain. When a gain is taxed, it is recognized. So you could have realized income, right? And there might not be recognized income. So we'll talk about 1031 as well. So calculating the gain, according to the IRC section 1001, the amount realized minus the adjusted basis, so we'll talk about how to calculate that, equals realized gain. So the way that you calculate this is cost of property plus any capital additions, so improvements, minus any cost recovery, which is depreciation, equals adjusted basis. We'll do an example later in the problem. The amount realized is the sum of money received plus the fair market value of any property in exchange, plus any liabilities shed. So if you got rid of a mortgage. Results from the sale or other disposition, trade-ins, casualties, condemnation, and theft. So the basis, the purpose is to keep track of after-tax dollars that are tied up in an investment. It allows the investor to recoup capital tax-free upon the sale. So we use basis to determine the gain and loss. We use it to determine depreciation deduction, and we use it to determine the at-risk rule for passive loss rules. So initial capital is the amount used to purchase. This includes cash, cost of property given in exchange, recourse debt used to finance it, and the cost necessary to acquire the asset, sales tax, freight, installation, etc. Any increase to basis is a capital infusion, so you're adding something. Amortization of discount bonds, profit of pass-through entities, so we'll talk about basis briefly in this course, related to partnership interest. Liabilities assumed. Any decrease in basis is return of capital, so distributions from a pass-through entity or depreciation on assets. Amortization of bond premium and any liabilities shed. So on personal use assets, initial basis equals cost. Basis is increased by any capital additions. Capital is recovered when the asset is sold and depreciation is not allowed. So non-business, personal use assets. Rex is a pharmaceutical consultant. He maintains his office in his home to run his consulting practice. Earlier this year, he purchased his principal residence for $350,000. His direct expenses related to the home office is $2,650, of which $400 represents depreciation. Rex's adjusted basis in his home is cost basis less depreciation because the $400 he has recovered through capital of his capital through a depreciation deduction. When he goes to sell it, he'll calculate any gain based on adjusted basis. Let's talk about basis of property acquired through inheritance. So I always say you want to make sure you inherit things correctly. The basis equals fair market value at the date of death or an alternative date 6 months later, sometimes called stepped up basis. It applies to testamentary transfers of property whose value is included in the descendant's gross estate. Barbie recently received an inheritance from her Uncle Ken. The inheritance consisted of 40% ownership of Malibu's funeral home, a family business started by Barbie's father, Skip, and her Uncle Ken. Uncle Ken paid $10,000 for his 40% ownership in the business, and it was worth $250,000 at his death. Barbie's basis in the inherited business that she received through the estate is $250 because she received it at death. Barbie's step up to fair market value increased the basis by $240,000. $250 is what she gets minus the $10 that Ken initially paid, and therefore that's stepped up basis. Section 1040 and joint tenancy. It applies to joint tenancy with the right of survivorship and tenancy by entirety. The property passes outside of probate. The surviving joint tenant is deemed to have received the property from the descendant. The basis is stepped up to the extent the value of the property is included in the gross estate. Results in a partial step-up basis. Step-up basis exceptions. Contemplation of death rule. Appreciated property is acquired by a descendant as a gift within 1 year of the death. The property passes from the donee to the descendant to the original donor or donor's spouse. So, bypassing that. Income in respect to a descendant's property and annuity payments transferred from the descendant to a beneficiary. The general rule is carryover basis for gifted property. So let's just say Uncle Ken here adds you to the deed before his death to avoid um, a nursing home taking the property. If that's the case and he adds you to the deed, you don't get stepped up basis because you didn't inherit it, it was gifted to you. And it's the change in the basis also included in the basis of the gifted property is any gift tax that you would pay. So impact of gift tax on the basis. So the donee's basis increased by the portion of gift tax paid if the fair market value is greater than the donor's basis at the date of death. So we take the appreciation in the property divided by fair market value of the property at date of gift times tax paid is the increase in the donee's basis. The fair market value at the date of gift is the amount of the taxable gift which includes a deduction for any gift tax annual exclusion taken. Jenna receives a gift from Brooks on June 15th of this year and has a fair market value of $20,000. Brooks' adjusted basis was $15,000 and he paid a gift tax on the transfer of $800. Assume the previous gift was equal to the gift exclusion. So Jenna's basis in the gifted property is $15,200. The gift plus the appreciation on the property. So that's 20,000 fair market value minus 15,000. So 5,000 divided by 20,000 times the 800 tax. So $200. If the fair market value of a gifted property is less than the donor's adjusted basis at the date of death, then the double basis rule applies. Therefore, to determine a loss, you must use the basis of the donee is fair market value. So we'll show an example, but basically you use fair market value instead of the actual basis when you sell the property at a loss. To determine a gain, the basis is the adjusted basis. All right, Sully purchased 100 shares of Hyde 5 years ago for $5,000. He just gave those shares to his son, Randall, when the value of the 100 shares was $1,000. So basically, this is the double basis. If you sell it for a loss, then your fair market value is used. So you start with 1,000. If you sell it for a gain, so you sell it for 6,000, then you use the adjusted basis of 5,000. If you sell it for 4,000, somewhere in between here, no gain or loss is calculated. Gifted property double basis. Randall sells shares for 5,500. Gain is 500. Randall sells shares for 750. The loss is 250 instead of the 5,000 original minus the 750. Randall sells 750 minus 5,000. So you use the 1,000, the lower part of the double basis. Randall sells shares for 3,000, no gain or loss. Holding period. So generally, when you gift someone property, the holding period is in the hands of the donee, includes the holding period of the donor. If double basis asset is sold for a loss, then the holding period for the donee starts at the date of gift. All transfers between spouses and incident to a divorce are treated as gifts, basis carryover. So you don't get stepped up basis at a divorce. Spouses are treated as one economic unit. Vinny and Lisa jointly own a house in Maryland and are in the process of getting a divorce. Vinny and Lisa each own 50% of the house, which has a basis of $100,000 and fair market value of $175,000. As part of the divorce settlement, Lisa will receive sole ownership of the house in Maryland. Lisa's basis in the house is $100,000. her basis was 50 and Vinny's carryover basis was 50. You don't get stepped up basis to 175 due to a divorce. Now, related party transactions, ancestors of the divorce of the descendants and brothers and sisters of the whole or half blood are related. If a gain results, then you have to apply normal tax rules. But you can't create a loss because the double basis rule applies if you sell something to a related party, and the holding period resets. A gain property has carryover basis. A loss property has double basis rules. And the holding period only resets if it's a loss, not a gain. I think we've briefly talked about depreciation, but depreciation allows you taxpayers to recover capital over the useful life of the asset. It may be claimed for assets used in a trade or business or held in the production of income. Capital invested in personal use assets is recovered when the asset is sold. Modified, accelerated, or cost recovery system is used for tax purposes for depreciation. So let's talk about real estate. Real estate has two useful lives, and they're straight line, not modified, accelerated. The residential real estate property, so this would be for rental properties. Residential is 27 and a half years, commercial is 39, and land is not depreciated. Personality is accelerated, so double declining balance. So for example, you buy a computer used in a trade or business. That's a 5-year asset and it starts with double declining balance. So there's more depreciation up front. Then there's 150% declining balance, which is 15 and 20 year. 15-year could be like a fence on a property, land improvements. David purchases an 8-unit rental apartment building for 900. The value of the land is determined to be 60,000. Since the property is used for residential rental, David will be able to depreciate the building. So the value is 840,000. The purchase price minus land. And it's depreciated over 27 and a half years. Therefore, David's annual deduction in depreciation on the rental unit is 30,545. Twyla purchases an office building she plans to rent out for one. The cost is 1.4 million and 200,000 is attributed to land. Since this is commercial rental, Twyla can depreciate the building, which is 1.4 minus 200, so 1.2, on a straight line basis over 39 years. Twyla's depreciation is 30,769.23. The depreciation convention. So you could have half your convention, but if more than 40% of your assets is placed in service in the fourth quarter, you must use mid-quarter convention, which gives you less depreciation in the year. The the real estate uses mid-month, so you must put the month that you put the property in to service. An intangible property is straight line over 15 years and referred to as amortization, like startup expenses. Oh, sorry. There is such a thing as bonus depreciation. Up to 80% bonus depreciation is available on new or used equipment put into service in 2023. For years prior to 23, it was 100%. Taxpayers can elect 50% bonus depreciation in lieu of the 80% rate in 2023. Property can be used for business or personal uses, like a car that weighs less than 6,000 pounds. It's called listed property. And property generally used for entertainment, recreation, or amusement purposes. If it's used more than 50%, the normal maker's rule applies. There is luxury auto limits, so there are auto limits on listed property. So one of the great things about depreciation is Section 179. It allows the business owner to expense capital acquisitions. The asset must have greater than 50% business use, and the limitation is 1,160,000 indexed for inflation for 2023. You cannot take 179 to generate a loss. So if I take 179 and I create a loss, then the excess would be carried forward to the future years. Expenses are phased out on a dollar-for-dollar basis for depreciable property placed in service in excess of $2,890,000. There are also special rules for vehicles over 6,000 pounds but less than 14,000 pounds. Section 179 is limited to 28,900 for 2023. There are three types of assets in the income tax system. We have our capital assets, ordinary income assets, and Section 1231 assets. All assets are capital except ordinary, which is accounts receivable, inventory, and creative works in the hands of the creator, and Section 1231. So you would identify these first. Depreciable real or personal property held for the use in a trade or business in the production of income and held long term. Amy purchased a painting by Worthington, an aspiring artist hanging in her dining room. She is not an art dealer, but rather a collector. The painting is a capital asset in her hands since she did not create it, and it is not being held as inventory to sell to her customers, and it's not depreciable property used in a trade or business. If about the taxation of capital assets. Long-term capital gains are taxed at a lower rate than ordinary tax rates. The rates are 0, 15, 20, 25 for unrecaptured Section 1250, and 28 for collectibles. Net losses, so net long-term capital losses, are limited to a 3,000 maximum against other income per year. So we have passive income, we have portfolio income, and we have ordinary income. So a $3,000 portfolio loss long term on the capital gains can only be deducted $3,000 a year against ordinary. Marie is a renowned artist in New England, and her work is sought after by the rich and famous. Marie painted her newest masterpiece. In Marie's hands, it's inventory, therefore an ordinary income asset. Frank is an art dealer and has galleries in New Orleans, New York, and San Diego. Frank recently purchased a painting by Wentworth and places it in his New Orleans studio for his customers. Because the painting is held for sale in the normal course of business, it is inventory, therefore an income asset. Copyrights to music is treated as a capital asset. So, taxation of ordinary income. It's taxed at ordinary rates. So if your federal tax rate is 24%, that's what you're paying. Losses generate a tax benefit at ordinary rates, and there's no limit because all of this is ordinary income. Homer, a prominent psychiatrist, purchased new furniture for his office. Since the furniture is being used in the trade or business, it's categorized as a Section 1231 asset. Gains are taxed at a long-term capital rate, but because it's 1231, losses are treated as ordinary. Long-term holding is required for Section 1231 assets. So a review. If it's a capital asset, it's capital gain treatment if sold for gain. If it's a capital loss treatment, current loss may be limited on capital assets. So $3,000 a year. Ordinary income is treated as ordinary income for a gain and ordinary loss, no limit. Capital assets are treated as capital gain treatment and part or all of recapture, and then ordinary loss treatment. So let me do an example. Let's pull up an Excel file here. So I'm going to make this a little bigger. So example. John purchases a beach home for $875,000. He's renting the beach home. It's not a personal use. He never uses it. So they value the land at the purchase of $60,000. Okay. So depreciable basis equals the $875,000 purchase price minus $60,000. So 875 depreciable basis. Let's just say John took depreciation over time. So John took 27,000 in depreciation, and then capital improvements, John made 50,000 in capital improvements. His adjusted basis in this property is 838,000. So we take depreciable basis, which is the building, right? Which is purchase price minus land. We take depreciation over time, so that subtracts, and we add capital improvements. So current adjusted basis building is 838,000. John sells the rental property for $1 million. So less the land. So we're going to subtract the land, less adjusted basis building. So we're going to subtract the adjusted basis in the building, and we get the gain. So John has a $102,000 gain. The first thing we do, section 1250 recapture on the gain, is anything that we took in depreciation. So 27,000 of this gain, section 1231, is the gain long term minus any recapture. So we break the gain down into recapture and section 1231, which is long term. How would we calculate the tax? Let's just say that they live in Florida. This is where the rental property is. So recapture is all at 25%, so 0.25. Section 1231 is either 0, 15, or 20. So let's just say John is at the 20% tax bracket. Now it depends. John could be subject to additional Medicare tax, which is another 3.8% on the gain. So we'll talk about that. But this is the gain that John would pay based on the adjusted basis. Now, it doesn't matter what John's mortgage was or if he paid cash for that. That's not going to change the gain calculation here. So that's an overview of how we would calculate this.